Hey everyone, John and Ray here, slingshotfutures.com. Today we're going to be talking about the cup and handle pattern. Now, the cup and handle, as with a lot of other trading patterns, derives its name from the way that it looks. It looks like a cup and handle. Just like a head and shoulders pattern looks like a head with shoulders, a cup and handle pattern looks like a cup with a handle. So if we mark up the cup and handle, it's going to look like this, where price action will come down, it'll start rounding out a bottom, it'll form a little handle, and it will go like that. So it looks like a cup with a handle. I mean, it is what it is. Now, you can see these as inverse as well, so you'll see it rounding the top, come up, and then down. It's just like you set the cup upside down. That's the cup and handle formation. And the way that the cup and handle operates is a type of usually a reversal pattern. So a downtrend will put in a bullish cup and handle in the sense that you're looking to buy a break above the handle portion, right? The cup is telling you to get ready. The handle is telling you it's action time. The break above the handle is when all of the fireworks kick off. Same goes for the downside, except obviously we're looking to short instead of buy. So the cup and handle formation by itself, it can be a little bit difficult to spot sometimes, especially if you're not used to looking for it. Because, I mean, let's be realistic. The markets aren't just going to form a perfect little bowl shape on the bottom. It doesn't work that way. Now, generally, it will look something close to that. You know, price will actually look something, you know, like this, right? It'll be a little bit shakier, but you'll get the general gist of a nice rounded bottom. Now, if we look at the crude oil chart here, this is a crude oil chart, a 5-minute chart, and I'll give you a second. Let's see if you can find it, right? We'll give you a second, pause the video, and just look at the chart and see if you can find it. Should be pretty obvious, right? And just like what we were talking about, we have a cup and handle formation right here. So, now, like we said, right, you know, the cup and handle formation, it's not going to be perfect. Nothing in the market is perfect. It's not going to give you that beautiful rounded bottom or anything like that. But it does give you a general idea that, yeah, this looks like a nice cup and handle. So what we're looking to do then, now that we have the cup and handle formation ready to go, what do we know? Well, the market telling us to get ready right here. It forms the handle here. And that's our action point to buy a breakout above the highs. Now, there's a couple different ways to approach this type of breakout. The first way is to trade it with a very tight stop, right? Now, a tight stop in the sense of, let's mark this up as nicely as I can here. We have the move up, right there, get the pull down and continuation up. So the entry point for the longs is a buying right there as a breakout. Now, with the breakout point here, you have a couple different options like we were just talking about. You have a very tight stop orientation, and this is usually the most common way to trade it, is putting a stop below that handle point, right? So if the market breaks below the low of that handle point, something's wrong, you read the pattern wrong, or it just failed, and it's time to get out. That's one way to trade it, and arguably probably the most commonly traded way. When it comes to targets, you can base one of two different things. You can base your target off of a 1-to-1 actual risk, going up like that, or you have the option to go for a 2-to-1. Now, as with most patterns go in and out of flavor when it comes to the markets. So generally speaking, in the long run, if you're always trading this pattern and you're always going for a 1-to-1, it's going to be a losing strategy. And that's simply because for a month, it might be the flavor of the month, and then the next month, it might not work at all. So to offset that long-term probability, which is what we care about, right? I care about what it's going to do over the next 7 years. Keep me around in the game, then we'll talk, right? So when we're looking at these cup and handle formations, going for a 1.5 or 2-to-1 makes a lot more sense in the long run. Your accuracy isn't going to be as good. Your accuracy is probably going to be floating around 40%. But your wins are twice as large as your losses, and in the long run, it is a profitable, mathematically sound strategy. So one thing to keep in mind, if the breakout point is happening in a location of other technical interest, there's nothing wrong with going for a 1-to-1, as long as other things back up that move. So if you're going to be buying a breakout, in this case, this breakout is happening right above the VWAP, above weekly support. We're breaking back above the moving averages. We've already put in an exhaustive low and rounding off of daily support. There's a lot of other things here that say, hey, this would probably be one of those situations where it's okay to go for a higher probability 1-to-1 type trade, knowing that you're not going to take this exact same trade in this context every time. And that's the important part to really consider with all patterns. is long-term feasibility, right? Again, with most patterns, they go in and out, flavor of the week, flavor of the month. You have to plan for long-term success. And planning for long-term success means most of the time you're going to be going for 1.5 or 2 to 1 on this type of trade. In the short term, though, if there is a reason to, you can go for a 1 to 1 if it, if it fits the context. Now, another way to trade this, and it's a lot more aggressive, would be utilizing a stop below the lows, because of the fact that that handle portion can get a little bit tricky, right? If we look inside of this, technically speaking, if you zoomed in a 1-minute chart, that might have been the handle right there for a breakout. That was a failure. This one might have been the high for a handle, right? That one failed as well. Excuse me. This one was the actual breakout point. That little bit of flexibility, giving it some room and not just saying, okay, you know what, I'm going to buy right here, my stop's going to go here. Caveat, this one would have worked if you did that. But you're putting your stop right there and you're not giving it any wiggle room at all. It might tap you out just to see it go flying higher. So give it a little bit of flexibility. When you're looking at these types of patterns, and really most patterns, you got to look at it as more of a gray area type of situation. But when you find these in the right place, under the right circumstances, with the right context, and you trade it correctly, they can be some monster runners, right? Look at this breakout on crude oil. I mean, if you're going for a 2 to 1, that was nothing. You could have gone for a 5 to 1 on something like that. So context, really, it always comes back to something that I say very frequently, and my members are probably sick of hearing. Context is everything. But in this type of situation, a beautiful cup and handle formation coming off of daily support, breaking above VWAP, breaking above weekly resistance, breaking above the moving averages, kind of hard to argue with that one. So, something to add to your tool belt if you haven't traded cup and handles before. They are a very useful strategy to potentially look for reversals, and with any reversal, any pattern, you got to give them a little bit of gray area. So that's going to do it for this one. If you have any questions, feel free to send me an email, jbrink@slingshotfutures.com. Don't forget, underneath the video, click on subscribe and the notification bell icon to the right of that, so you're notified every time one of these videos comes out. But aside from that, as always, enjoy the rest of the day. Hopefully you had a great trading day, and we'll see you in the next one.